Hello everyone. These are unprecedented times. We are living through the worst recession of our lifetime. We have seen the earlier crisis, the energy crisis of 2000, food price crisis of 2007, financial crisis of 2008, great recession of 2000, and now the great coronavirus recession or the great lockdown. This is considered to be the steepest recession since the Great Depression in 1930. In fact, the earlier recessions were either economic or financial or political crisis. In fact, the current crisis is a combination of medical, economic, finance, all put together. It's really the most difficult of all crises and recession. According to IMF estimates, global recessions occur over a cycle lasting 8 to 10 years. During what the IMF terms the past 3 global recessions of the last 3 decades, global per capita output growth was 0 or negative. For India, what are the positives for India? The biggest benefit for India is a drop in the crude oil prices. India is the 3rd largest importer of crude oil in the world. For every $1 drop, India saves $1.5 billion. With the present $30 decline, India will save nearly $40 to $45 billion. Another benefit is lower trade deficit with China, improved by $10 to $12 billion. India's dependence on exports is relatively small compared to most other countries. The current account deficit will fall sharply and the fiscal deficit will go up in the current year due to taxes on oil products will not be able to offset the loss of revenue under the current economic situation. According to IMF, the real GDP growth of the emerging and developing economies is on an upward trend, and that of the advanced economies is on a downward trend since 1980s. Another important benefit for India is India has been exporting medicines, HCQ, to the countries where needed. It has put India on a firm standing and in good position in front of the world. World will remember such actions. This is considered to be negative for China because it is looked as one country which has exported coronavirus. Another benefit is the supply chain disruption and diversification effect. Most of the companies are now willing to relocate from China. Japan has already given stimulus of 2.2 trillion to shift companies out of China. This is a good opportunity for India. If the central government, state government all come together, and attract these companies to India, it will increase the economic activity and boost the economic growth of the country. For that, infrastructure also needs to be developed. It should not happen that in 1980, India lost Samsung to Vietnam. In 2020, it should not happen. And the main contenders seems to be India, Indonesia, and Vietnam for these companies which are willing to move out of China. Coming to the equity. As this crisis is a medical crisis, medical solution and the physical and monetary stimulus is the only solution. As of now, many pharma companies are working overtime for a breakthrough. Some of them are already in human trial phase. If the world is able to be successful in getting the vaccines in place, the economic growth will begin. It is hard to forecast whether the market has bottomed out or not. Depends on the medical solution, and when it comes, and when it does, the market will not wait for anyone to recover. FIIs and FPIs selling has impacted our markets. They have taken their money to their country, where the COVID-19 deaths are more and the GDP is much lower than in India. So ultimately, money will come back to India. The market, the Sensex, the market has already gone back almost 4 to 9 years as of now. The large cap equities are trading at 2016 levels, mid cap at 2014 levels, and small cap at 2011 levels. So it is prudent to invest now as markets will recover fast. Sensex has already gone down to 25 and recovered to 32. This recovery could be due to the expectation of a second stimulus from the government and the expectation of a fast solution to this pandemic. And on the control on deaths, cure versus prevention, India is in a much better situation compared to UK, Italy and USA. So it's a good opportunity to buy equity, but need to pick right stock as there is extreme volatility ahead. Pharma has not peaked. Going forward, every country will focus on improving their healthcare infrastructure and systems, and moreover people will adopt to a healthier lifestyle. Now, how to invest? During these times, it is prudent to divide your incremental equity investments into 2-3 phases. During uncertain mode, stagger investments for the next 10 to 12 months or a year, and secondly, on a certain mode, when solution to the pandemic is found, invest the remaining 50%. Invest on companies which are holding cash. One can invest depending upon the risk appetite and the comfort level. For conservative investors, large cap. For not so conservative and medium conservative investors, mid cap. And for the aggressive investors, small cap. When the market moves, large cap moves first, followed by mid cap and small cap. Maximum benefit will come from the small cap companies. The sectors could be new age economic companies, pharma, FMCG, food processing companies, online companies, healthcare, sanitation, e-commerce, telephone and power sectors. These companies will benefit the most. Real estate, commercial or residential, financial companies, hotel, tourism, travel, leisure companies will be most affected due to low demand. Bigger names may stay, but small players will exist. In fact, companies across sectors that have leverage will suffer the most. Servicing will be an issue with very little left for the equity holders. So it is advisable to focus on companies rather than on sectors, and also invest in companies which manages leverage well. The other asset class could be gold, where the liquidity is high and interest is low. It does well, considered to be a safe haven. There can be increase in prices in gold as China's central bank may invest the surplus reserves in gold. So we can invest in gold bonds for 5 to 7 years, or gold ETFs with a 1 to 3 year horizon, which is more liquid. On fixed income, look at mutual funds which are equity based. Don't stop SIPs. As of now, SIPs are getting invested at lower NAVs. Stay invested, stay home, stay safe.